Welcome to the deep dive. This week, we're really trying to sift through some pretty conflicting signals in the crypto market. Signals that tell us a lot about short-term noise versus, long-term belief. Because if you just scan the headlines, it looked bad. Really bad. Historic outflows of institutional money, Bitcoin's price taking a nosedive. But then, if you look under the hood, say, at the reports from a massive U.S. brokerage, the story just flips. You see this, surging, sustained client interest. So how do we make sense of that? How can you have, over $1 billion just walk out the door from Bitcoin ETFs, while at the same time, a place like Charles Schwab sees client interest accelerating?
Yeah, that paradox is exactly what we need to unpack. And the numbers, they're really starkly different. On one hand, like you said, over $1.2 billion pulled out of U.S. spot Bitcoin ETFs just this week. Real institutional money heading for the exits.
Yeah.
But then the other side, you've got Schwab clients now owning, get this, 20% of all crypto ETPs exchange-traded products in the entire U.S.
20% from just one brokerage's clients.
20%.
Yeah.
1/5 of the whole market held by clients at just one firm. It's staggering.
Okay, that really frames the tension. It's institutional players versus maybe more retail-focused long-term holders, and they're seeing things completely differently. So let's start with the panic side of the institutional selling and that price drop. So we saw this major sell-off this week. Maybe just quickly, for everyone listening, how does that actually work when big money pulls out of these spot Bitcoin ETFs?
Right. So a spot Bitcoin ETF, it's designed to track Bitcoin's price directly. When big institutions decide they want out, they redeem their ETF shares. And this involves key players called authorized participants, or APs.
Okay, the APs, they're the middlemen, sort of.
Exactly. They're the crucial link.
Yeah.
When these redemption requests get big enough, and $1.22 billion in a week is definitely big enough, the APs have to actually go and sell real Bitcoin on the open market. That's what keeps the ETF's share price tracking the actual Bitcoin price, the net asset value. And naturally, that much selling pushes the price down. And this wasn't just a trickle, it was heavy selling. The sources show that across the 5 trading days, only Tuesday saw any kind of minor inflow. The rest was just outflow, outflow, outflow.
And it hit the big names too, right? Not just the usual suspects like Grayscale.
Oh yeah, absolutely. BlackRock's iShares Bitcoin Trust, which everyone watches, had its biggest outflow day ever on Friday. Something like $268.6 million. Gone.
Wow.
Fidelity's fund lost about $67 million. Even Grayscale's GBTC saw $25 million lead that same day.
So just between those three, you're looking at almost $360 million heading out in one single day. No wonder the price reacted.
Precisely. Bitcoin dropped over $10,000 through the week, started around, $115,000 Monday, and by Friday, it hit a low point we haven't seen in 4 months, just under $104,000.
Ouch.
Yeah, and to drop that sharp that quick, it suggests it's more than just a few people taking profits. It feels like large-scale risk reduction, maybe systematic selling.
Why now, though? Any specific theories? End of quarter stuff, or?
Could be several things. Maybe institutional funds rebalancing portfolios, perhaps mandates kicking in that force them to cut back on volatile assets when things get choppy.
Or maybe tax loss harvesting. Selling now to book a loss against other gains.
That's definitely possible too. It's likely a mix. But the immediate trigger seems to be the price momentum itself. The price starts falling fast and it triggers more selling. It's kind of like this. Imagine the Bitcoin price is like the water level at a beach, and it suddenly starts dropping really fast.
Okay.
The ETFs, these big institutional funds, they're like fishermen who see the tide going out unexpectedly quickly. What do? They pull their nets out of the water fast.
Right. They don't want their nets stranded on dry sand.
Exactly. It shows they're reacting to the immediate turbulence. They're choosing liquidity, getting their capital safe, rather than maybe riding out the storm at these price levels. Short-term survival.
That makes sense for funds judged quarterly. But okay, this brings us perfectly to the other side of the coin, the Schwab story. Let's pivot now from that institutional fear to this, frankly, surprising story of stability and even growth coming from the retail side, especially through Charles Schwab. Why is Schwab such a big deal here? I saw ETF expert Nate Gerasi saying this is something everyone should be watching.
Yeah, Schwab is crucial for a couple of reasons. First, just their sheer size. They're massive. And second, the kind of clients they have. We're not talking about crypto-native exchange users necessarily.
Or traditional investors.
Right. Often people managing retirement accounts, long-term wealth. They tend to be maybe a bit older, wealthier, and they're accessing crypto through their existing trusted brokerage. That usually signals a different kind of commitment, less about quick trades, more about long-term allocation.
And didn't their CEO, Rick Wurster, sound pretty positive about crypto ETPs, even with the market tanking?
He did. And you can see why when you look at their internal numbers. That statistic we mentioned earlier, Schwab clients owning 20% of all U.S. crypto ETPs, it's just wild.
It really is. It suggests they're grabbing a huge slice of the pie from investors who prefer these traditional investment methods.
These are people likely integrating crypto into like a standard diversified portfolio, not just betting the farm on it.
So less speculation, more allocation.
Seems that way. And the engagement trend is also telling. Worcester said visits to Schwab's crypto information site are up 90% in the last year. 90%.
Wow.
He didn't just say it was popular, he used words like very active and high engagement.
Oh.
So it's not just people holding passively, they're actively researching, likely accumulating.
Okay, so this sets up a really clear contrast. Institutions running, maybe panicking, Schwab clients steadily buying. This really highlights that difference between short-term panic and long-term accumulation, doesn't it? It's like the institutional outflows are all the loud noise you hear traders shouting, running for the exit door, making a racket. But the Schwab engagement numbers, that's like looking inside a huge stadium in the market and seeing this large, quiet crowd just steadily buying up tickets, the ETPs, for the big game they believe is starting next year or the year after.
Yeah, that's a great way to put it.
They're showing confidence in the future value, not getting spooked by the current waves. They're buying the dip while the big guys are scrambling for the sidelines.
And Schwab sees this. It's clearly influencing their strategy. They already offer clients crypto ETFs and Bitcoin futures, and they've announced plans to offer direct spot crypto trading probably around 2026. They want to capture more of that highly engaged client base.
Okay, but let me play devil's advocate for a second. Isn't this sometimes what happens near a market top? You know, the retail bowls them over narrative. Could Schwab clients just be the ones catching the falling knife that the institutions, maybe with better info, already dropped?
That's a fair question, and it's always a risk. But I think the context matters here. That 20% ownership wasn't built in a week. It represents wealth moving into crypto ETPs over time, and ETPs are generally seen as longer-term holding vehicles than, say, day trading spot crypto. And the fact that the high ownership is paired with that massive 90% jump in engagement in researching crypto on their site, it suggests it's not just FOMO buying. People seem to be educating themselves. It might be less about timing the absolute bottom and more about believing in the asset's value over the next decade.
Interesting point. So the type of buying and the engagement level suggests something more durable.
Potentially, yes. Now, let's widen the lens a bit, put this week's crash into some historical context. This price action we're seeing, it's actually really unusual for October.
Right. Uptober, they call it.
Exactly. CoinGlass data shows Bitcoin usually posts gains in October. Historically, it's been positive in 10 out of the last 12 Octobers.
But not this year, so far anyway. We're down about 6% for the month. Is the Uptober magic broken, or is this just a blip?
Well, the analysts mentioned in the sources seem to think Uptober isn't dead yet. They're suggesting this is maybe just an early month shakeout.
Hope springs eternal, with analysts say.
Sometimes. But their reasoning is often based on historical patterns. If October gains are coming, they often tend to show up more in the second half of the month. So the message is kind of like, hold tight.
But what are they actually pinning those hopes on? Is there some big catalyst they expect to outweigh all this institutional selling we just talked about?
The big one everyone seems to be watching is the Federal Reserve. Specifically, anticipated rate cuts.
The macro picture.
Exactly. If the Fed signals they're going to start easing monetary policy, lowering interest rates, that tends to pump liquidity into the system and makes borrowing cheaper. Historically, that's been rocket fuel for risk assets.
And Bitcoin is definitely seen as a risk asset.
A high beta one, yeah. It tends to benefit disproportionately when interest rates fall and money gets looser. So that's the hope that a Fed pivot could turn the tide.
Okay, so let's try and tie this all together for the listener. What we're really seeing are two different types of market participants behaving in opposite ways. You've got the institutions driven by short-term performance, momentum, maybe those fund mandates or tax reasons. They see volatility, they see the price drop, and they react quickly. They run for the door to preserve capital. Their horizon is maybe the next quarter. But then you have this other group, shown by the Schwab data, maybe more retail, maybe long-term, traditional investors using brokerages. They see the same price dip, but their reaction is different. They show deep growing conviction. They're accumulating through ETPs, looking potentially years down the road.
Right.
And that's why you absolutely have to look beyond just that scary headline number about outflows. You have to ask who is selling and why, and crucially, who is buying and why.
Absolutely. The short-term price swings, yeah, they're driven by these large, fast institutional moves. But the underlying trend, the foundational belief in the asset, especially among this growing base of brokerage clients, that seems to be getting stronger, not weaker, despite the turbulence.
That really is the core takeaway here. Understand the players, understand their motivations. Now, just to leave you with something to think about as you watch this market unfold. If Schwab clients already own a fifth of the entire U.S. crypto ETP market just using these indirect products, what happens to the overall crypto market demand maybe in 2026 if Schwab actually rolls out direct spot crypto trading to its millions and millions of clients? Just something to chew on. Okay, that's our deep dive for this week. If you found this useful, please do follow, like, and share it. And definitely follow What Bitcoin Taught Me. You can find us on Twitter, X, Nostr, Blue Sky, Threads, Instagram, Facebook, and LinkedIn. Thanks so much for listening.